Markets in record territory. Is there complacency out there among equity buyers? Let's get more from Nora Yousif, Senior VP and Senior Portfolio Manager at RBC Wealth Management. Nora, thanks very much indeed for joining us today.
Pleasure, Andrew.
Do you get a feeling that there's too much euphoria out there?
There is a bit of that. Markets are like a roller coaster. They are slow and quiet on the way up and fast and screaming on the way down. So what I tell investors, especially now when we're at market all-time highs, is don't get too complacent, don't get too comfortable. It's really now is an opportune time to review your portfolio. Make sure no one position or sector is overly concentrated, because one of the biggest mistakes I see people make in times like this is taking their eye off the ball.
The volatility, I know you professionals look at volatility. And volatility has dropped a lot, which can indicate that the market is too comfortable with itself. What do you mean by volatility? Is that day-to-day fluctuations in stocks and markets?
Yeah, exactly. And for lately, we've really just been seeing the volatility being low and the market continuing to go up. So again, in times when you see that happening, it's a great opportune time while things are a little quieter to take another look at the fundamentals. Make sure you're properly diversified and your time horizon is in line with your risk tolerance, all of those things that we know well to do. And you don't want to be playing Monday morning quarterback. So while diversification doesn't entirely correct proof your portfolio, it can help take away some of that pain during those market downturns. It might not be the best strategy at any point in time, but over time, it's most certainly provides more consistent, predictable returns over time.
We're still in an era of great optimism over AI, and it is pretty incredible. I mean, I'm scared. Sometimes I use ChatGPT or another engine, and I'm scared by how powerful it is. You say it's not just going to transform tech and the tech sector, it's going to transform wide areas of the economy.
That's exactly right. The big takeaway with AI is that the use cases, typically we think, okay, tech, but we see that broadening out to other sectors of the marketplace, particularly any sectors that are data heavy, because after all, data is what makes AI tick. So think financials, healthcare. I mean, when we're considering our own bodies, there's 37 trillion cells. That's a lot of data to work with. So, another point is that the AI is moving so fast that it's going to be difficult to predict who are the sustainable winners and losers over time. And there's technologies even beyond AI. When I was at MIT, the big focal point was quantum computing, which seemed decades away. Now it's seeming more like 5, 10 years away. It's the next frontier that will be worth watching and can bring about even more change faster in getting us to crack those codes for cures for diseases. So the real two main takeaways for investors there when considering AI, which is on every earnings call, is about thinking about sectors beyond technology and think about broad-based ETFs exposed to AI instead of trying to stop it.
Yeah, so without recommending or commenting on individual ETFs, you think that's a reasonable way to play it, an AI/quantum ETF even?
I do. Again, the pace of change is accelerating so quickly with technology. When you look back in the 1930s, the average span of a company in the S&P 500 was 90 years. When they retested that in the year 2000, the average span of a company in the lasting in the S&P 500 went from 90 years down to 12.
Wow.
And that's why the pace of change, again, is only accelerating. So yes, we're big fans of the ETFs.
Broadly speaking on bonds, bonds, people say, they're not as exciting as stocks. And some people even say, well, I can get a better dividend yield from blue chip stocks than bond yields currently. But how should people think about bonds? Should they own at least some?
It's a great question. When the market's at record highs, you don't really hear fixed income getting a lot of love, but I urge people not to sleep on fixed income portion of their portfolios, because finally you're actually getting some tangible income out of fixed income. And rates are still elevated. We're still over 20-year highs. So there's still this window of opportunity here before it shuts down on us to lock in these elevated yields for the long term, or at least as long as you're not going to need cash per se. And, cash otherwise is going to have some serious FOMO as rates do go down. And those high yield savings accounts, although they were great when rates were going up, as rates go down, well, they won't be as high.
Just thinking about the Mag 7, the likes of Meta or Nvidia or Amazon, companies seen as big winners from AI. I mean, they can't keep going on up forever, can they? I suppose there is a danger they'll get to ludicrous valuations and then drop.
Yeah, we're going to be seeing the earnings are coming out this week for the Magnificent Seven companies. And so there, again, you don't want to be overly exposed to any one stock, any one sector. And also, when that volatility comes, whether it's tariffs, there's a lot being thrown at the market this week between the August 1st deadline, Liberation 2.0, earnings reports, employment data, the Fed. So regardless of what happens, it's just important not to make any drastic, sudden moves. For example, had you sold back in April at the low, you missed out on this 25% run up in the market.
Maybe we could put up a 1 year for the NASDAQ 100 as a proxy. Yeah. Wasn't it interesting that around April 8th was such a spectacular market bottom? Smart day to be buying stocks.
It was quite the run up. It was a 54-day return, one of the fastest in history.
Finally, leave us with a final thought. Just to give people a scorecard for the year so far, we have the S&P, the NASDAQ composite up about 9% so far this year. Do they have much more to run? I mean, could we have another amazing year of 20% plus gains?
Well, my crystal ball is as clear as your crystal ball. And so what I can say is that, listen, the second half of the year is digesting a lot of things. All these tariffs, these new trade deals that are being had, and the developments of the big, beautiful bill, which has provided more certainty, more clarity to not just retail investors, but businesses and their tax situation. I'm certainly getting some relieved phone calls when talking to retirees, which is certainly my lane, of now that we know what we're working with in terms of projections and income planning. It certainly makes things easier.